My son has arrived to be in the video. What I love about investing is that we're actually owning these businesses. We're not just buying ticker symbols, but we are legally owning the assets that these companies have. So as business owners, we should always look for companies that are strong and growing. And in the case of what we do here on the channel is dividend growth investing, I always have an eye toward companies that pay off a dividend that return some of the profits to us, the shareholders or the business owners. And I've dug through a whole bunch of retail stocks in the spirit of the holiday season to bring you 4 that I think look pretty interesting. They all have good dividends that I think are solid. And speaking of investing, I would like to thank you for investing some of your time here on the channel and making me a part of your investing journey. I got my dividend growth portfolio up here on the board. Well, we share the taxable account as one of them, so there's a link to Dividend.com in the description below, so feel free to click on that and snoop around. And if you're helped at any way, shape, or form, or at any point in this video, click the thumbs up and let's get to it. Best Buy is the largest pure-play consumer electronics retailer in the United States, and they have nearly a 40% share of offline sales. Their inventory was up 13% from pre-pandemic levels, and now that was broadly in line with the fourth quarter stacked comparable growth guidance of 12%, so that's why I say look for inventory and earnings and growth that are going up in tandem, and that shows that they're able to navigate these supply chain disruptions. Now, Best Buy recently acquired digital health company Current Health. They're a UK-based provider of remote patient monitoring and engagement technology for $800 million, and St. Louis-based Yardbird, which is a direct-to-consumer outdoor furniture brand, for $85 million. Best Buy's current 2.40% dividend has largely been growing and sports a low 19% payout ratio and a 14% 10-year growth rate. Shares are about fairly valued and about 24% under the 5-year price to earnings ratio average. And I see support around the $110 to $113 area, which could be a good entry point. Big Lots, ticker BIG, is principally engaged in operating discount retail stores throughout the United States, and they have around 1/3 of their stores in California, Texas, Ohio, and Florida. Now, companies like Big Lots should do well when people are looking for details, and they are defensive in nature. My son has arrived to be in the video. They have an initiative called Operation North Star, which encompasses driving their top line, cost containment, and infrastructure enhancements, so as well as also pantry optimization and store expansion endeavors. Big Lots dividend yield is at 2.67% and has not increased since 2018, but it is very safe in a low 17% payout ratio and has been growing at 10.2% the last 5 years. Big Lots is currently 28% below their 5-year PE average, and they are in a bit of a downtrend, but I see that they've found support about the 100-week moving average since mid-October, which is currently at about $45.50. Analysts have a $52 price target, which is about 16% upside from here, and I think Big Lots, which I held in the past and I sold way back when because I thought they were overvalued around $25, I think they're a great defensive buy and hold that you should consider adding to your portfolio. Kohl's Corporation, ticker KSS, they operate about 1,162 department stores in 49 states, and they also operate as a large digital sales business. Did you know that women's apparel is Kohl's largest category, having generated 25% of its 2020 sales? They've had recent solid sales and margins thanks to their merchandising and cost and their e-commerce, which experienced a 17% compound annual average growth between 2015 and 2020, making Kohl's one of the largest online retailers in the United States. Now, Kohl's dividend is only at 1.81%, while they cut their dividend by 74% during the pandemic sell-off of 2020. Over the past 10 years, they still have a 17% growth rate and a ridiculously low payout ratio of 7.94%. There's a lot of support around the 200-week moving average, which is currently at about $48, and Yahoo has a price target of $70.64 on Kohl's, giving them about 28% upside from here. Now, while 55% of their sales are from retail, I do expect them to remain competitive, and I expect that Dividend to keep growing and eventually getting back to pre-pandemic levels. Foot Locker Incorporated, ticker FL, they operate thousands of retail stores throughout the United States, Canada, Europe, Australia, and New Zealand. They also have one franchisee in the Middle East and one in South Korea, which I did not know, and those operate multiple stores in those areas. And their store names include Foot Locker, Champs, and Runners Point, and they also have an e-commerce business selling through footlocker.com, East Bay, and Final Score. Foot Locker also recently announced plans to buy Eurostar, which is the parent company of US-based athletic footwear and apparel retailer WSS for $750 million, and text trading company KK, which is the owner and licensor of Japan-based streetwear retailer Atmos for $360 million. Now, with most of their retail stores being inside shopping malls and shopping centers, it makes sense to shift more online, as more than 60% of their 2020 revenues were generated through digital channels. Foot Locker announced the supply chain issues, but they say they're ready for strong holiday demand, recent support around the $45 level, and Yahoo gives them a price target of $67, which would be about 34% upside from here. Like Kohl's, Foot Locker cut the dividend 37% during the pandemic of 2020, but that was after seeing many years of double-digit dividend increases. They have a 2.41% yield that is easily covered by their incredibly low 6.24% payout ratio, and even factoring in that 37% cut, the 10-year growth rate is still at 4.5%. So Foot Locker, like Kohl's, I think is going to keep increasing that dividend, and they're going to get it back to pre-pandemic levels. I'm also interested to see that they're acknowledging that they need to be more in those digital channels and into e-commerce, so they're growing and expanding there. I like to see that, and I wonder just when it's going to be they'll open up their metaverse shop and start selling NFT footwear. I would definitely recommend taking a deeper look at Foot Locker and seeing if they're a good fit for your portfolio. Now, I had to give an honorable mention to Lowe's, which I think is a little bit expensive right now, depending on what you consider expensive. But I mean, look at that. It literally takes a pandemic to bring them below their 50-week moving average, which they're basically allergic to and very rarely get close to, let alone go below. And check that dividend out, which has been increasing for 59 straight years, making them a dividend king, a very low 24% payout ratio, and an astounding 18.3% 10-year compound annual growth rate. I think they're expensive. They're a little bit overpriced, but as I'm doing with Pepsi, baby, if you want quality, sometimes you gotta pay up for quality, because if you're waiting for it to be cheap, somebody's gonna have to sell it to you cheap, and all I'm saying is who's selling you Lowe's on the cheap. And if you are not into individual stocks and you would like to buy exposure to a big basket of retail companies all in one shot, well, check it out. We have an ETF for you to consider. It is the State Street SPDR XRT ETF, Exchange Traded Fund. It has exactly 100 retail companies, and of the ones we just chatted about, Foot Locker, Kohl's, and Big Lots are included. It has a very small dividend yield of only 0.76%, but do keep in mind there is a 0.35% expense ratio on the fund, which will eat into some of that. So I'm not big on ETFs because I don't like the low yields and I don't like the expense ratios that you have to pay. So I like to pick the individual stocks that I think are going to give me a solidly growing dividend, which is what I'm most concerned about in this portfolio. I do, of course, invest into Vanguard ETFs in my 401k and my IRA retirement accounts. But for what I'm doing here for the bridge portfolio, where I want to generate lots of passive income coming in every month, every week, every year, I'm going after the individual companies. Let us know what some of your favorite retail stocks to own. And I just talked recently about 5 dividend stocks that I am indeed buying forever, which you can check out here, and I will talk to you there. top line, cost containment, infrastructure. I can't do this. Big Lots dividend yield is at 2.67%, and it has not increased since 2018. Son. About the 100-week moving average since mid-October.